At 92 years old, Warren Buffett is largely regarded as the greatest investor of all time. Since assuming control of Berkshire Hathaway in 1965, he has continued to serve as its chairman and CEO. For comparison, Buffett increased the stock's value at a compounded annual gain of 20.1%, which is nearly twice the 10.5% annual total return of the S&P 500 over the same time period. This difference might not seem significant until you consider the impact of compounding over time. For comparison, $1,000 invested in Berkshire should have generated $36.4 million. Every $1,000 invested in the S&P 500 would have generated $302,000. How did Buffett manage to make such a huge difference, though? The key to Warren Buffett's success is his fundamental grasp of value investing. He is aware that stocks are more than simply prices and charts. They are an ownership interest in a legitimate company. Therefore, when investing, you should approach it as if you were a business owner. Buffett's success has been largely attributed to his long-term holding of investments in companies that have enduring competitive advantages. Buffett uses the earnings and dividend payments from these companies, which have wide economic moats and provide substantial cash flow, to reinvest and buy stock in additional successful companies. Despite the fact that Buffett's company Berkshire Hathaway does not pay dividends, it undoubtedly enjoys receiving them in 2022. This has a substantial compounding effect over time. Over $6 billion in dividend payments from their portfolio of publicly traded stocks are anticipated, or $6 billion in a single year. In addition to their operating revenue from completely owned companies like the BNSF Railroad, Geico See's Candy, Nebraska Furniture Mart, etc., they also receive this in the present day. In this video, I'll analyze each of Warren Buffett's current dividends and explain the crucial role they've played in his success as an investor. You might be discouraged about investing as a result of occurrences like the 2022 stock market catastrophe. There is negative emotion everywhere. You may be influenced by the media, but now is not the time to let your long-term objectives slip your mind. The motivation behind this video today is to assist in bringing back into focus for our community some basic investing ideas. Warren Buffett is the best person to help with it. As a value investor, like Warren Buffett, you seek to purchase stocks that are currently trading for less than their true value. Seems straightforward, but there's a lot more to it. Even the legendary Warren Buffett has seen his approach to investing change dramatically over time. He transitioned from trading what he called, quote, "you used cigar butts" to long-term ownership of quality companies. Ben Graham has taught me to make quantitative purchases. I was taught to look around for things that are cheap in 1949 or 1950, and it left a lasting impression on me. As a result, I started searching for what I like to refer to as cigar bunches of stocks. The cigar butt approach to stock investing entails searching for cigar butts on the street until you come across this. Since it only had one puff remaining, the cigar was truly awful. You could toss it away, but it was free, or at least inexpensive, and you could use the money to seek another one-puff cigarette, which is exactly what I did for years. Even though we profit from it, it's a mistake since you can't succeed at it with large sums of money. Now it's so much simpler to simply purchase fantastic enterprises. I would prefer to do so over a fair business at a great price. You actually want to be in a wonderful business because time is its friend. You continue compounding, it keeps generating more revenue, and you keep accumulating wealth. His investing partner Charlie Munger had a significant impact on his decision to shift his attention to the quality of the underlying firm. The best way they could have learned that value of quality was by investing in See's Candies, but we both never stopped learning. Because of this, the men we were 5 years ago were less wise than the men who ultimately appeared, and See's Candy did teach us both a valuable lesson that it will also teach you. If I were to tell you the whole story, if See's Candy had demanded $100,000 more, I would have fled because we were so naive at that time. 10,000 more. And one of the reasons we didn't walk away was because we weren't going to pay a cent more.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
Ira Marshall told us that we were being insane and that we were undervaluing quality by not paying the price for some goods. Warren and I, on the other hand, instead of acting in many situations the way we do, listened to the criticism, altered our minds, and it is a really excellent lesson for anyone. You may say that Berkshire has been developed in part by learning from criticism if you consider all the money we made from accepting that one complaint, and if you count the indirect consequences from what we learned from purchasing See's. I'll tell you right now why leaving See's Candy in 1972 would have been a bad decision. The business had $31 million in sales and $2.083 million in profits after taxes the same year. Berkshire Hathaway purchased the entire company for $25 million. In addition, the company required $8 million in working capital to operate. Buffett was unwilling to pay more than the $25 million he proposed because, in his estimation of the waters, doing so would have been foolish. As of 2007, See's Candies had generated pre-tax profits from Berkshire Hathaway of $1.35 billion. Also that year, See's sales totaled $383 million, generating over $82 million in pre-tax profit, meaning Buffett had more than tripled his initial investment and continued to see candy every year. Based on this, it didn't matter one bit whether they paid $1,000 or $1 million or even $10 million more, because things have only gotten better afterwards. In 2019, Buffett claimed that See's had generated over $2 billion in pre-tax profits and that Berkshire Hathaway's chocolate company continued to be a cash cow. See's Candies is an example of what Buffett values in a company. By investing heavily in its brand and its customers' loyalty, the corporation has developed a competitive advantage. In a stable sector, long-term competitive advantage is what we look for in a business, according to Buffett. If it comes with quick organic growth, terrific, but even without it, such a corporation is profitable. Simply put, we will remove the lush profits from the company and use them to purchase competing firms abroad. This is precisely what he accomplished with See's Candy, a business with little room for growth but steady cash flow. All of Buffett's subsequent investments would reflect this philosophy of making excellent purchases at reasonable costs. What does this have to do with dividend stocks, some of you may be asking? See's Candies are, in theory, a dividend stock nonetheless. Berkshire owns all of the business. Almost all of the profits are distributed to Buffett, so he may reinvest in new businesses. It would be a huge mistake for See's Candy to keep the money, so they distributed Berkshire, and we hope that we move that money around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value. See's Candy has practically paid everything they have earned to us. This is because they don't have the ability within See's Candy to use large sums that they earn intelligently in their business. If See's Candy were a standalone business, we would simply distribute all of the profits and dividends, just as we do now, with the exception of Berkshire. Despite the fact that the bulk of his holdings pay dividends, Warren Buffett does not specifically target dividend equities. This association results from the types of businesses he pursues. Dividend stocks are frequently issued by established, high-profitable corporations that have successful business concepts. As I indicated earlier, this closely aligns with Buffett's investment preferences. Berkshire Hathaway is on track to receive $6.07 billion in dividend income from its holdings of publicly traded companies over the coming year. Only 5 of those holdings will be responsible for 71% of the dividend. Buffett just added Chevron, CVX to his list of the greatest dividend payers. In 2022, He bought 163.53 million shares, giving him 8.4% ownership of the business. He receives a prospective annual dividend of $5.68 million from Chevron, which pays a quarterly dividend of 1.42 cents per share. Buffett will now receive a total of $928.86 million in dividend income every year. I don't know about you, but I wouldn't mind that at all. Additionally, Chevron increases its dividend payment over time and is likely to do so in the near future, which will raise his subsequent payments even further. Given that Chevron's most recent dividend rise was 5.97, it appears that Buffett will shortly get his first payout of $1 billion. This is a fresh addition to his repertoire, as I already said. How much does he cost then? The first quarter of 2022 saw the majority of Berkshire's Chevron purchases. His projected cost basis per share is $146.56, which results in a 3.88 dividend yield on cost. Buffett has in the past sold energy stocks after a few years, but he has never held a stake this size. He also purchased another oil and gas stock, which we will talk about in a moment. If this turns out to be another long-term holding for Berkshire, only time will tell. Bank of America, ticker symbol BAC, is his second largest dividend payer. He acquired his stock in 2011 at a price of roughly $14 per share on average. He holds more than 1 million shares, or 12.9% of the corporation. The quarterly dividend payment from Bank of America was just boosted by 4.76%, bringing the yearly payout to 88 cents per share. The dividend yield on cost for Bank of America's $908.9 million dividend payment to Berkshire Hathaway over the upcoming year is approximately 6.28%. Another recent addition to the list of dividend payers is Occidental Petroleum, ticker symbol OXY. Although he has a long history with Occidental, in 2022 he made his largest bet to date. 188.36 million shares, or 20.2% of the firm, are owned by Berkshire. Following the 2020 oil crisis, Occidental cut its dividend distribution and is now gradually rising it again. The dividend is only projected to pay out $98 million to Berkshire the following year at this modest amount, but it will undoubtedly increase with time. Additionally, due to the company's history of paying out preferred dividends totaling additional $800 million, Berkshire owns $10 million in preferred stock. This values the annual dividend income of Western at $897.95 million. The ticker symbol for Apple, AAPL, comes in fourth place. Berkshire Hathaway now owns more than 5.7% of Apple after Warren Buffett made significant investments in the company in 2016. Although he has already realized a sizable return on his investment, I believe this stock is set to become his next outstanding dividend growth pick. Since Apple is currently the most valuable brand in the world and enjoys extremely high customer loyalty, he is expected to get $842 million in dividends this year. His cost basis is anticipated to be $34.26 per share, giving him a 2.68 dividend yield on cost. Furthermore, it has a sizable program for stock repurchases, and it has been raising its dividends for over 9 years. If after 30 years, Buffett doubled his initial investment every 2 years through dividends akin to his investment in Coca-Cola, I wouldn't be at all surprised. Referring to Coca-Cola, which ranks 5th on the list. Since 1988, Buffett has held the ticker symbol KO for the Coca-Cola Company. This fits the C's Candies model and is one of the best instances of long-term investing. With an original cost base of 3.24 cents per share, this investment will provide dividend income for him of more than $704 million this year. Currently, Buffett has a 54.2% dividend return on cost, which indicates that dividends alone are more than tripling his initial investment every 2 years. For more than 59 years, Coca-Cola has steadily increased its dividend, and there are currently no signs that this trend will reverse anytime soon. This is a perfect example of a long-term investment in a business with significant competitive advantages. Over 71% of his $6 billion in projected dividend income comes from these 5 stocks. Numerous other long-term holdings, such as American Express and Moody's, in addition to Coca-Cola, have outstanding dividend yields on cost. But this is only his portfolio of publicly traded stocks. Additionally, Berkshire Hathaway has a sizable portion of wholly owned companies. Buffett reinvests the earnings from fully owned companies and dividends to purchase new profitable businesses. This feeds Berkshire Hathaway's compounding engine as you keep investing to boost your earning potential in the future. That is a great way to increase your wealth. Because of this belief in reinvesting money, Berkshire Hathaway as a firm does not declare a dividend.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.